Holy smokes, it ain't no joke. The crypto market just pulled off one of the wildest Monday morning moves we've seen in months, and if you blinked, you might have missed it. Over $1 billion in crypto positions got liquidated in under 1 hour. Gone just like that. Long traders crushed, leverage accounts wiped out, and the charts went red across the board. If you woke up and saw your portfolio diving, trust me, you're not alone. Bitcoin, Ethereum, XRP, nothing was safe from this wipeout. And at the very same time, we've got big voices like Coinbase's CEO telling us what's next for regulation, Elon Musk and Donald Trump showing up side by side, and Binance's CZ suddenly popping back into the spotlight, stirring up speculation. This is a perfect storm moment in the crypto market, and I'm going to break it all down for you so you know exactly what just happened and where the opportunities may be setting up. This is not financial advice. Now, before we dig into the billion-dollar wipeout and the ripple effect it's having on XRP, I need to tell you something important. If you're serious about making life-changing wealth in this market, I've put together something special for you. It's called the XRP Millionaire Blueprint, and it's loaded with a step-by-step document, a full infographic, an exclusive video breakdown, and more. This is designed to give you clarity and confidence while the rest of the market panics. You'll find it linked right now in the pinned comment below this video. Go grab it because opportunities like this don't wait around. Let's get back to the action. Here's what went down. In just a few minutes, around 9 a.m. Eastern, the crypto market got hit with a cascade of liquidations. More than 47,000 traders were taken out of their positions in a single day, with total liquidations climbing past $1.7 billion in the last 24 hours. Ethereum traders lost about $283 million. Bitcoin saw over $200 million vanish, and XRP holders felt the sting too. Roughly $55 million in XRP positions wiped away almost instantly. That's the kind of move that sends shockwaves through the market. Not because of bad news, not because of a hack, but simply because leverage positions were stacked way too high, and one domino falling set off the whole chain. And if you've been watching crypto long enough, you know this is how it usually plays out. Greed fuels leverage. Traders stack 25x, 50x, even 100x longs thinking they can't lose. Then one big move down, whether triggered by a whale, an exchange, or just sheer market mechanics, smashes those over-leveraged positions like glass, and suddenly you've got cascading liquidations where every margin call just forces more selling. That's what we just witnessed. Take Bitcoin, for example. It dropped from about $114,000 down to test support, near $112,000 in minutes. Ethereum tanked about 5% in the same window. XRP, which had been hovering near 0.288, cratered right alongside the majors. And across the board, the charts turned red. 20% moves in a single day on some altcoins. That's not just volatility. That's the kind of wipeout that resets the whole playing field. But here's the important part. Nothing major in the news caused this. No SEC lawsuit bombshell, no exchange going bankrupt, no Fed surprise. This was a pure technical liquidation cascade, and when that's the case, the rebound opportunities often come quicker than people expect because the fundamentals didn't change. XRP didn't suddenly become worthless. Bitcoin didn't stop being digital gold. Ethereum didn't lose its entire DeFi ecosystem overnight. This was traders getting overextended and the market punishing them. Now let's talk about the timing because this wasn't random. Mondays in crypto have a reputation. You've got weekly candles closing on Sunday night, futures and options opening with a fresh slate, and liquidity can be thin compared to the middle of the week. Throw in the fact that this week happens to line up with Rosh Hashanah, the Jewish New Year, historically a time when Wall Street saw less trading activity from key players. And you've got the perfect cocktail for weird, thin, easily manipulated market moves. Even in today's digital trading world, those old seasonal patterns can still leave their fingerprints. Another curious detail, the so-called Altcoin Season Index briefly spiked to 100, then crashed back down to 67 despite Bitcoin dominance barely moving. That kind of glitch makes traders nervous. Algorithms trade off these signals, and when they see anomalies, they can pile on to already fragile moves. So between the timing, the leverage, and the algo weirdness, the setup was there for exactly what we saw this morning. Meanwhile, CZ from Binance has re-entered the chat, literally. After laying low for a while, he's been active again, tweeting about specific projects and even hinting that the biggest bull market ever might still be ahead. Then right after today's wipeout, analysts pointed out that most of the positions liquidated were on Binance. 100x longs on Bitcoin, 50x on Solana and XRP, 25x on Ethereum and others. Practically nothing flushed on BNB itself. Coincidence? Maybe. But it's hard to ignore that the biggest exchange in the world is always right in the middle of these liquidation cascades. So, was Binance directly responsible? Not necessarily. But when you've got that much leverage stacked up on their platform, one sharp move can trigger the chain reaction we just watched unfold. Whether it was a whale dumping or an algo misfiring, Binance was the battlefield where it played out. And here's the kicker. Even as this chaos was happening, Coinbase CEO Brian Armstrong was out there dropping a major piece of bullish news. He's been pushing the Clarity Act, the next big piece of US crypto legislation, following the Genius Act that just passed. The Genius Act cleared the path for stablecoins, giving them legal clarity. The Clarity Act aims to do the same for all non-stablecoin assets like Bitcoin, Ethereum, and yes, XRP. This isn't just regulatory noise, this is the freight train moment for crypto in the US with bipartisan support from Congress and momentum in the Senate. Armstrong says he's never been more confident that we're about to see this passed into law. And that matters, because big money, the hedge funds, the pension funds, the institutional investors, they don't jump into markets clouded by uncertainty. They want rules, they want clarity, they want to know exactly how they can operate. Once that framework is locked in, the floodgates open. That's the kind of catalyst XRP needs to move from speculative asset to mainstream adoption tool. And the timing couldn't be more perfect because we've also got XRP spot ETF applications lined up, waiting for approval. Combine legal clarity with ETF access, and you've got a recipe for massive inflows of capital into XRP. Now, I know a lot of people look at a day like today and panic. They see $1 billion in liquidations and think the bull market is over. But history tells a different story. These flushouts are how markets reset. Weak hands get shaken out. Over-leveraged traders get punished, and solid investors holding strong assets like XRP position themselves for the next leg up. Dips like this don't signal the end. More often than not, they lay the foundation for the next big rally. And that's where we are right now. The market just showed you how fast greed can collapse. The question is, are you ready to position yourself before confidence floods back in? Now, as wild as that billion-dollar liquidation sounds, it's just one layer of what's shaping up to be a critical week for crypto and XRP. Beyond the flash crash in Binance's shadow, the bigger picture is what's happening on the policy front, the macroeconomic stage, and even in the cultural spotlight with figures like Elon Musk and Donald Trump showing up together again. Each of these elements is creating ripples that converge into the same current, and XRP sits right in the middle of it. Let's start with Brian Armstrong's comments about the Clarity Act. This legislation is different from anything we've had before. For years, the crypto space has lived in the fog of regulation by enforcement. Agencies like the SEC would launch lawsuits, drag projects into court, and retroactively claim authority over tokens. XRP itself was the prime example, caught in a battle that dragged on for years and spooked investors even though the underlying technology never stopped advancing. The Clarity Act aims to end that uncertainty once and for all. The idea is simple but powerful. Define what assets fall under securities law, which ones are commodities, and give everyone, exchanges, issuers, and investors a clear framework to operate in. Stablecoins already got this treatment with the Genius Act. Now, it's time for the rest of the crypto market to have that same level of predictability. Armstrong emphasized that this isn't just wishful thinking. The bill already passed the House with bipartisan support, which is rare in itself. And more importantly, the Senate seems motivated to push it through. He even used the phrase, "This freight train has left the station," suggesting the momentum is too strong to stop. Think about the ripple effect of that clarity. Once the law is passed, institutions can confidently hold Bitcoin, Ethereum, XRP, and others without fearing a regulatory ambush. Exchanges can offer products like derivatives and staking with certainty about their legal standing. And new investors, both retail and institutional, gain the confidence that comes with knowing the rules of the game. That's why clarity is so often repeated as the holy grail in crypto. It doesn't matter if the rules are strict or lenient. What matters is that the rules are there, written, and stable. Money hates uncertainty. And right now, clarity is about to erase one of the biggest uncertainties this industry has ever faced. Now, layer that on top of the XRP story. Ripple's technology is already embedded in global payments, remittances, and banking pilots. Major financial institutions like Santander, Bank of America, and SBI Holdings have explored or tested Ripple's Prosper solutions. The one barrier, uncertainty about whether XRP itself is legally usable in the US. Once that's cleared, Ripple doesn't just get regulatory green light, it gets legitimacy, which is rocket fuel when combined with the possibility of an ETF. Speaking of ETFs, let's not forget the importance of timing here. Spot XRP ETFs are on the table, and they're coming at a moment when the market desperately needs new inflows. Bitcoin ETFs already brought in billions of dollars when they launched, and Ethereum ETFs followed with their own wave of capital. An XRP ETF approval would be historic, not just because it opens the doors for mainstream investors, but because it positions XRP as the first digital asset outside of the big two, Bitcoin and Ethereum, to be ETF approved in the United States. That's no small feat. ETFs mean retirement funds, wealth managers, and brokers can buy XRP without touching crypto wallets, exchanges, or private keys. It's plug-and-play access for the masses. And that's exactly how trillions of dollars in traditional markets can start flowing into digital assets. Now let's zoom back out to this week's macroeconomic calendar, because the Fed looms large here. Jerome Powell, the Fed chair, is scheduled to speak on Tuesday. Wednesday brings new home sales data. Thursday has durable goods orders and the GDP print. And Friday closes the week with the PCE inflation report, the Fed's favorite inflation metric. Why does this matter for crypto? Because macro data controls liquidity. If the economy shows signs of slowing, markets may start pricing in future rate cuts, which injects optimism into risk assets like Bitcoin and XRP. If inflation surprises to the upside, traders brace for tighter policy, which can weigh on all markets. Crypto doesn't move in a vacuum. Every Fed decision, every inflation print, every GDP update creates ripple effects in sentiment and liquidity. And here's the interesting angle. The liquidation event we just saw happened before all this data comes out. In a way, it cleared the field. Leverage got flushed, weak hands got shaken, and now the market has space to actually react to the week's news instead of carrying dangerous overhangs. Sometimes the timing works out like that, wiping the slate clean so the real moves can start on stronger footing. Now on to Elon Musk and Donald Trump. These two aren't just celebrities. They're cultural power centers. When they fight, it grabs headlines. When they reconcile, it signals alignment between influential forces. Recently, they were spotted side by side at an event hosted by Charlie Kirk, and the symbolism didn't go unnoticed. Remember, Trump has pivoted hard into being pro-crypto. He's explicitly stated that he wants the US to be the global capital of cryptocurrency. That's not just political rhetoric, it sets the tone for regulators, agencies, and future legislation. And Elon Musk, he's always been a wild card in crypto, swinging markets with a single tweet. Whether it was pushing Dogecoin, hinting at Bitcoin integration with Tesla, or criticizing centralized exchanges, Musk knows his influence. Seeing them on the same page is a subtle but powerful signal. It suggests alignment between political leadership and cultural megaphones, both leaning towards supporting crypto adoption. It doesn't directly cause XRP to pump tomorrow, but it contributes to the larger atmosphere of acceptance and momentum. Crypto isn't being pushed to the fringes anymore. It's moving into the spotlight, and leaders are choosing to be associated with it rather than distance themselves. Back on the technical side, let's revisit what happened with liquidations. Traders often ask, why does the market crash so violently on the downside, but rarely surge as quickly to the upside? The answer lies in psychology. When prices rise, leverage builds gradually. Traders keep adding to positions thinking they're safe. But when prices fall, liquidation levels are hit rapidly, creating forced selling that cascades faster than buying ever does. It's the nature of leverage markets. Fear is sharper and more immediate than greed. That's why dips like this feel brutal, but can also mark turning points. Once the overhang of leverage is gone, assets trade closer to their organic demand. If buyers still believe in the fundamentals, and many do with XRP, especially with ETFs on the horizon, then the recovery can be equally sharp. It's also worth noting that not every coin got hit equally. BNB, Binance's own token, barely saw any flush despite the chaos. That's raising eyebrows because it suggests internal mechanics might have spared BNB while other tokens got annihilated. Whether that's true or not, perception matters. Traders notice when one exchange's native token is safe while others bleed, and those narratives stick around. Meanwhile, data from on-chain analysts shows that whales, the biggest holders, were not panic selling during the crash. In fact, some increased their holdings at lower levels, scooping up discounted assets while retail traders got wiped out. This behavior is classic. Institutions and whales use volatility to accumulate positions while fear dominates headlines. So where does this leave XRP specifically at a fascinating crossroads? On one hand, it just endured a painful flush that shook out over-leveraged traders. On the other, it's staring at potentially historic catalysts: ETF approval, legal clarity, and political tailwinds. Add in the fact that whales continue to accumulate, and you get a picture of a market setting up for a major move. And don't underestimate seasonality here. September has often been a shaky month for markets, both crypto and stocks, but October has historically brought rebounds. Last year, September was red, October was flat, but November exploded higher. Traders call it October for a reason. If history rhymes, the current dip may be setting the stage for an October turnaround, just in time for clarity and ETF news flow. Now a quick look at correlations. Bitcoin still drives the overall crypto market, but XRP has been showing signs of decoupling. During certain news events like Ripple's partial victory against the SEC, XRP surged independently of Bitcoin. If ETFs or regulatory clarity specifically tied to XRP arrive, we could see another decoupling moment. And those are the moments that create outsized returns, when an asset breaks free of the market tide and charts its own course. And here's the key point to carry forward. What just happened with the billion-dollar liquidation is not a sign of collapse. It's a sign of a reset that could prepare the ground for the catalysts lining up right in front of us. The second trading day of the XRP ETF was perhaps even more telling than the first. Opening bell enthusiasm had already been priced in, and now markets were shifting toward a more data-driven reality. Analysts were no longer looking at mere symbolism. They were dissecting volume, liquidity, and institutional order flow to understand whether XRP's ETF could sustain momentum or risk fading into the background like so many other hyped launches before it. The first observation that stood out was the pattern of inflows. Unlike some spot ETFs that see massive front-loaded retail participation before a tapering effect, the XRP ETF showed a surprisingly steady pace. The order book was balanced, suggesting that much of the activity was coming from systematic allocation strategies rather than speculative retail frenzy. That single data point was massive because it implied institutional hands were at play. Pension funds, family offices, and algorithmic rebalancing systems don't chase candles. They allocate with discipline, and they stick around. Another detail worth noting was the arbitrage effect. As XRP ETF units began trading, arbitrageurs quickly moved in to align the ETF's price with the underlying spot market on centralized exchanges. This efficiency lowered the premium discount window almost immediately. That matters more than most realize. The tighter the spread, the more professional traders are willing to use the ETF as a liquidity instrument, creating a positive feedback loop. Now, critics pointed to a reality check. The first day inflows, while strong, were nowhere near Bitcoin's record-setting ETF launch earlier this year. But comparing XRP to Bitcoin here is both misleading and unfair. Bitcoin had a decade plus of institutional lobbying, regulatory debate, and media spotlight behind it. XRP, by contrast, emerged from years of courtroom battles and skepticism to suddenly step into legitimacy almost overnight. If anything, XRP's ETF launch had an even more uphill battle, making the early numbers all the more impressive. Liquidity depth was another fascinating story. Traders were stunned to see the bid-ask stacks on the ETF fill out so quickly. On-screen liquidity often tells a story about confidence. When the order book is thin, institutions don't trust execution. When it's dense and layered, it signals faith that supply and demand will balance without chaotic swings. For XRP, the ETF order book was robust by day 2, indicating that participants were already comfortable treating it like a serious financial product. Then came the ripple effect, no pun intended, across exchanges. Within hours of the ETF launch, centralized trading venues saw XRP volume surge. Retail investors who might not have access to ETFs in their jurisdictions instead turned to spot markets. This dynamic isn't unique. Bitcoin and Ethereum experienced similar spillover effects, but it was validation of the thesis that ETFs don't cannibalize liquidity. They expand it. One question hanging in the air was how traditional finance would integrate XRP exposure now that it had a regulated vehicle. Portfolio managers who previously dismissed crypto allocations as too complex now had no excuse. A compliant exchange-listed ETF is a checkbox that satisfies most risk committees. And as those managers began dipping their toes into XRP exposure, the broader financial world started realizing that this asset wasn't a fringe token anymore. It was a sanctioned instrument with tradable, reportable infrastructure. The second-day commentary from institutions was illuminating. A major investment bank strategist noted that XRP's liquidity profile was well beyond expectations, while a hedge fund manager compared it favorably to early-stage commodity ETFs that matured into trillion-dollar markets. Even skeptics admitted that the ETF launch was more successful than anticipated. That tone shift, subtle as it might be, is exactly how sentiment transforms from curiosity into conviction. Another key storyline was derivatives. Futures volume linked to XRP began spiking as institutions sought hedging strategies around their ETF allocations. This mirrors the playbook we saw with gold ETFs in the early 2000s. Once a spot vehicle exists, the derivatives market builds around it, creating a layered ecosystem of liquidity. For XRP, that meant that traders could now construct sophisticated strategies involving ETFs, spot, and futures, an evolution that cements XRP into the DNA of financial markets. But here's the most overlooked detail: retail psychology. Many in the community had grown disillusioned after years of regulatory purgatory. XRP was always the future that never arrived. The ETF changed that narrative in one stroke. Suddenly, social sentiment shifted from defensive optimism to offensive pride. Community members weren't asking if XRP would survive. They were asking how big it could get. That psychological inflection point can't be understated. Narratives move markets as much as fundamentals, and XRP's story had just been rewritten. Of course, challenges remain. Regulatory uncertainty still lingers in global jurisdictions. Some banks remain hesitant, preferring to wait until liquidity seasons further. And critics argue that XRP's circulating supply still raises questions about valuation sustainability. Yet, the ETF launch doesn't eliminate these concerns. It reframes them. Instead of being existential threats, they're now hurdles in the path of an asset already integrated into mainstream finance. In fact, some analysts are already revising their XRP price models. Previously, forecasts relied heavily on adoption curves for cross-border payments and institutional partnerships. Now they're adding ETF flows as a core input that fundamentally shifts the valuation equation. Flows from retirement accounts, sovereign funds, and passive indexes can dwarf traditional adoption models, meaning XRP's potential upside may need to be recalibrated entirely. By day 3, something extraordinary was happening. Commentators were no longer talking about whether the XRP ETF was a success. They were debating where it ranked among the most impactful ETF launches in history. That's a leap of perception that only happens when momentum is undeniable. And here's where the long game becomes crystal clear. ETFs are sticky. Unlike speculative spot trading, ETF allocations often sit in portfolios for years, even decades. That means every inflow we're seeing isn't just temporary demand. It's embedded demand locked into retirement accounts and wealth management systems. Each passing week that inflows remains steady builds a stronger foundation under XRP's price. We are without question watching a historic shift unfold in real time. XRP has broken out of the shadows of speculation and into the spotlight of legitimacy. Whether you're bullish, bearish, or undecided, one thing is clear. The narrative has permanently changed. The launch of the XRP ETF didn't just open a new trading product, it opened a new chapter in financial history. And if you want to understand how to position yourself in this new era, how to navigate the flows, the cycles, and the hidden mechanics behind what could be the most transformative investment opportunity of our lifetime, you'll want to check out the XRP Millionaire Blueprint, linked right now in the pinned comment.